Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Samir Narang, Chief Economist at Bank of Baroda, joining in. Samir, always a pleasure to have you on the show and speak to you. Samir, my first question coming to you is, all this while, in the last 2 to 3 months, we have been talking about an economic recovery that had started to pick up. But taking into consideration that vaccinations have been out, taking into consideration that India is already in the second wave, do you think this economic recovery is something which is going to be sustainable, or do you think it's going to be a repeat of what we saw in 2021?
No, so if you so there are two ways to look at it, right? One is you can uh, you can look at the last cycle and then project when is the likely peak of the current infection rates, and then when would the second phase of the recovery will continue. The second way to look at it is looking at externally what other countries have gone through in terms of the spread of the infection, and then finally some of the countries where vaccination rates are far higher than India's. So how things will shape up in the coming few months. So I think both the lenses are important when you evaluate the way forward. So if you look at the spread of the infection last time around, it was essentially uh, 10, around about the incremental rate of infections was 10,000 or thereabouts in the month of June. And it peaked at more than 90,000 somewhere in September, mid-September. And then it, came down back to that 10,000 level incremental rate of infections at around about February, mid-February. So I do not see any change in terms of the spread of the virus, in terms of the number of months it typically takes for the virus to spread. So we were at around about 10,000 infections then in February, and we've reached more than 2 lakhs. So the rate of growth is very high. But in terms of weeks, perhaps you can say we are another, 3 to 4 weeks away from the peak, perhaps. Though peaks will be different in different parts of the country. Maharashtra may have peaked for now simply because we have restricted movement. In other states where movement is still there, perhaps restrictions will come in play and the spread will gradually come off in perhaps towards the later end of May or early June. So, depending on which state where you are, but as a country as a whole, perhaps we will peak soon enough in the next, 3 to 4 weeks. That is the what we've learned from the last cycle, and we have restricted our activity. So we should ideally peak around about that time. Now let's look at the external lens. What's happening around the world? So what we see is that once you reach a certain mass of vaccination levels, then of course the country opens up. You look at the United States today, you look at United Kingdom, you look at Israel, where the vaccination rates are very high. There, more or less, the economy has opened up, but people will need to wear masks. They need to carry some form of social distancing still, till such time we have a complete grip over the virus. The CEO of Pfizer is saying that you need to take a shot after 12 months as well. So perhaps it is there to live with us, but we will over time manage the virus and control our behavior, and we'll be able to live our lives as normal as possible. So I think we in the next few weeks the challenge will continue for India, but there is a road to recovery driven by vaccination. Yeah,
Yeah,
sorry.
right. So with this now, what's the kind of impact do you see on the economy when we're considering the second wave and all the positives that come around the vaccine, etc.?
Right. So in terms of economic growth, the IMF, for instance, has forecasting a growth of 12.5% for the financial year. RBI is forecasted 10.5%. We at present are at the midpoint. Actually, we are at 11.5%. But the current restrictions are going to impact growth. If you look at state by state, more than 50% of India's GDP at present would be in some form of restrictions, particularly the services sector. This is going to impinge on growth. Maharashtra, which is a very large contributor to the manufacturing economy of the country as well, is also imposed severe restrictions on manufacturing as well, apart from exports. So domestic manufacturing is also likely to have an impact this month and perhaps next month as well, as supply chains restore over time. So we believe in such an environment, ideally 25 to 50 basis points of reduction in growth is possible. So perhaps we'll veer our growth estimates closer to 11% than 11.5% that we are at right now. So there will be an impact on Q1 growth, particularly. However, the good thing is that as vaccination rates improve, you may see a much more reasonable pickup in H2, and we may cover up some of the impact that we are seeing right now.
Right. So, Samir, with this now, if you have to talk about what the RBI has said with regards to where the growth is concerned in FY21 and 22, what is it implying with regards to where the repo rate is concerned as well? Do you think they are indicating that at least in terms of calendar year 21, we will not see any change coming in on the repo rate? Or do you think there is a possibility where we could start seeing increases happening?
No, that's a very good question. I think from the RBI standpoint, they've focused more on growth around the after the pandemic hit the country. That's been true for most of the global central banks. If you see most of the global central banks, they have prioritized growth over inflation. The forward guidance given by a number of advanced central banks, such as the US Fed and ECB, is towards restraining rates to the lower end of the curve so as to give growth a chance. I think we've learned a lot from the last global financial crisis as well. When 2013, the taper tantrum happened and the US rates actually moved up, particularly the mortgage rates moved up and had slowed down the US economy. I think all the major central bankers are willing to give growth a chance at the expense of inflation to some extent. However, what the advanced economy central banks can do, the emerging economy central banks cannot afford to do. The advanced economies have had a problem of lower inflation for a while now. The Fed had changed its principle towards targeting a 2% inflation rate, I believe, in 2012. And since then, they've not reached that level on a sustainable basis. So that's why they want to be playing an asymmetric, giving it an asymmetric chance in terms of let the inflation run a little bit higher, but they want to give growth a chance. But in case of emerging markets, some of the central banks have already started moving rates higher. You have Brazil, which has moved rates higher, which is expected to do again when it meets soon enough. You have Turkey, which has raised rates. You have Russia, which has raised rates now. And there will be a few more central banks that raise rates in the coming months. In India's case, inflation has been persistently high. We've seen 6.2% or thereabouts last year, which is far higher than the RBI's upper end of the tolerance level as well. The RBI's framework remains at 4% for the next 5 years. And inflation, as per RBI, next year is also looking at around about 5%. And the current restrictions, they're only going to add towards upward pressure on inflation, not towards downward pressure, simply because of lockdown restrictions, supply chains get disrupted, and that is inflationary more than anything else. That's what we've seen last year as well. So, in the above context, though RBI is willing to give growth a chance, but inflation is a perennial problem now for last year and looking to be a problem even this year. And as per RBI's forecast, the inflation will remain above its target even next year. So, in that context, policy normalization is inevitable, as you correctly pointed out. Our sense is that the first way to move would be to align the rate corridor between the repo rate and the reverse repo rate, which has been expanded to 65 basis points. So perhaps you'll see a little bit of reverse repo rate hikes to tighten the corridor, to bring the operative rate of monetary policy, which is the call money rate, closer to the repo rate and the reverse repo rate where it is right now. And then eventually looking at a repo rate hike somewhere in early FY23. Because the US Fed or FOMC is signaling a rate increase somewhere in 2023, end of 2024. So even if they bring in their forecasts ahead, perhaps the lift off in the US will happen in 2023. So we'll have adequate time for the RBI to raise rates and prep the markets by closer to 18 to 24 months.
Right. So, Samir, with this now, as you mentioned about the inflation and that, do you think RBI will be able to ignore inflation completely if it goes haywire, just to concentrate on growth and recovery?
So, the inflation. So, what caused higher inflation last year, right? So, let's look at it that way. So, it was essentially driven by food, particularly vegetable prices. Uh, and some of the other items, such as the oils and fats, which have seen a complete rebalancing because of the global energy cycle, have been high. Same is the case with pulses. So, given the way prices have run up, do we see another bout of prices running up to that extent? Perhaps not, right? The other thing is that from the domestic economy standpoint, we also raised taxes for particularly for energy prices for matching or meeting our fiscal needs. So perhaps there may be a case that the government is budgeting a very muted increase in some of the indirect taxes, particularly excise. I believe they may be in a position to cut some of these taxes as we move ahead to balance the needs for the consumers and inflation and the fiscal needs. So that fine balance needs to be done at some point in time. So that obviously backdrop tells us that perhaps inflation, because of the supply side constraints, the supply side constraints may not push inflation up to the extent they had pushed it last year. On the demand front, if you strip out the supply side constraints and only look at the demand side, then obviously the demand side the inflation is very muted in the country right now. So it's essentially the supply side constraints which are pushing it higher. Will it become endemic in a way, and can it go to the levels we had seen in the 2014 to 16 period? It doesn't look like that we are in that phase as of now. And if that is the case, then RBI would have to move sooner than what we are anticipating right now. The last cycle, there were a lot of external issues as well. We were looking at a current account deficit of approximately 5% of GDP. Fiscal deficit was in excess of that. The rupee was looking very vulnerable. So that time, the policy mix required a very different solution. As of now, inflation, of course, is a concern, but still, it is looking like it will fall below 5% this year on an average, unless and until some other supply shock hits it. So, as of now, it doesn't seem an immediate or an imminent a sudden reversal of policy. I think we can go through a glide path and normalize things as we move ahead.
Right. And Samir, overall, globally, we are seeing a lot of liquidity infusion that's coming in. Now,
Yeah.
another aspect that we are seeing with this is that emerging markets, a few of them, the central banks have already gone ahead and increased their policy rates. And they've done this way before the US monetary policy cycle could turn.
Right.
Now, taking this into consideration, how do you expect the RBI to react to this situation?
Correct. So I think the central banks that have raised rates, they are facing some unique problems, right? And the problem essentially is either because of geopolitics or because of growth. So to name three central banks that have done it, one is Russia, one is Turkey, and the third one is Brazil. All three of them are facing some or the other unique problem, and because of which their currency has collapsed. In case of Brazil, inflation is at a very high level, in mid-teens, I believe. Turkey also is around about those levels, and their currencies have seen a very distinct turn in the last couple of months. Last year, Turkey was in the eye of a storm. This year also, there have been changes in the central bank. So there are certain endemic issues in some of these geographies. In India's case, growth is looking like it will come back. this year, though it may be lower than what we had thought earlier when infection rates were around about 10,000 versus now above 2 lakh. So, but still, the medium-term outlook is not looking that bad. Some of the government schemes, particularly the PLI and the privatization program that the government is proposing now, they all are growth positive moves. So overall, one can say is that in India's case, we have time because of some of the structural reforms we have taken, some of the decisions taken by the government, and the faster pace of vaccination that may follow in the coming months. It is very likely that in India's case, the recovery will be strong, sustainable, and the India's corporate cycle is never looked better than it has in the last decade. So there are a lot of positives going for India because of which we have time to reverse monetary policy and give growth a chance. However, having said that, it's always prudent to move before the US Fed moves. So we have to time the cycle. And that's why I said that early FY23 perhaps is the best time to lift off rates when you have given growth a chance and your growth is looking like sustainably it will come back.
Right. And do you think that the RBI has been banking on the government's plan to increase infrastructure spend, say probably to expand the PLI scheme, and that's something they have been concentrating on as well?
No, of course, the monetary and fiscal policy has to move together. And to that extent, softer rates when the economy is in a tough spot always helps, particularly from a borrower's perspective, or you look at from the NBFC's perspective. If they can get lower rates, they will have enough and more margins to provide for credit costs, which are likely to jump in such an environment. So it's always better to be cautious from that perspective and give growth a chance. So from that lens, if you look at it, I think RBI has done a very good job of forecasting the overall impact on different sectors. They came out with those 26 sectors and including pharma under the Kamath Committee report. A restructuring scheme was run very tightly, efficiently. The good thing is that not many corporates came up for restructuring. So they were able to manage within the current available liquidity, they were able to generate cash flows. If you look at the impact of lower interest rates, perhaps on the real estate, if you look at stamp duty collections over the last quarter in December and now in Q4, it's been one of the best quarters real estate industry has seen in a very, very long time, perhaps. So outlook for a number of sectors has changed because of the proactive steps taken both by the central government, some of the state governments like Maharashtra reduced stamp duty, and the RBI. So all three acted in unison for registering a much stronger response, which will be beneficial for the economy in the long run.
Right. And Samir, with this, another thing that everyone's concentrating right now is on what's happening to the bond yields. Clearly, if you go to see with regards to bond yields, the 10-year spiked, and this is ahead of the bond purchase. Now, overall, here the government or the RBI, for that matter, is trying to contain, the yield curve. How do you see this moving? Because the GSAP program is focusing on specific points on the yield curve where the RBI wants to bring down the yields.
That's very true. So actually, there are two parts to it again here, right? So one is the global backdrop, and the other one is the domestic backdrop. So if you look at the global backdrop as such, the global yields have moved up, led by the US, where yields have gone up by more than 70 basis points this year, and that is what is driving the global yield cycle right now. In the case of India, yields have gone up, but not to that extent. And that is also because of the simple fact that RBI has been guiding the markets towards a much lower outlook towards yields in the medium term, and it's a accommodative stance. The In the last policy, RBI did announce, as you're correctly saying, a GSAP program of 1 lakh crore in Q1, and the first auction was done on 15th of April, which which is yesterday. And post that again, the yields have actually gone up because perhaps the expectations were not aligned with the market thought in terms of the extent of purchase that RBI would do at the long end. So all of these are market expectations. At the end of the day, the in the domestic context, you are generating a deposit growth of close to 10 to 11%, which implies an additional 15 lakh to 16 lakh crores of deposits. The credit growth has been muted last year, so the incremental demand for credit offtake was only approximately 5 to 6 lakh crores. So the balance, which was 7 to 8 lakh crores, got deployed in the bond market. Now, as growth recovers, at some point in time, credit growth will recover. And when that happens, the incremental needs for the credit demand implies that there will be less available for the bond market. And to that extent, yields have to structurally move up, given the demand supply balance of deposits, whereas the need for the private sector in terms of credit and the government sector in terms of bond yield, the bond issuances. Now, the only difference here is that the foreign ownership of Indian bonds is approximately, I think, less than 2% compared to many other countries where it would be in mid-teens to maybe 25, and I think US it's upwards of 30%. So if we can open up that market, and there are talks that India may be included in the FTSE bond index to begin with before and eventually included in the MSCI, that may open up a window of opportunity for foreigners to pick up bonds, and that may reduce bond yields on a sustainable basis. But given the domestic context and the needs for the private sector and the government sector, structurally, of course, bond yields need to go up.
Right. So what's the kind of range, Samir, lastly, that you're looking at with regards to bond deals? And in turn, how are you expecting the Indian rupee to react to it as well?
Right. So in terms of bond yields, we do see yields probably heading closer to 6.5 towards the end of the financial year. And in terms of INR, our view is it is going to be on the depreciating bias up to till such time we have not peaked in terms of COVID. And once the infections start coming down, perhaps you will have some room for appreciation. But a lot depends on the outlook for DXY and the US yields as well. In terms of India, what we've seen is the biggest sensitivity is to FPI flows. And once the growth recovery starts, perhaps you will see incrementally more FDI and FPI flows into the country. And that's positive for the INR. But in the interim, as we see, the extent of flows have come down. So reasonably, INR is under pressure. However, having said that, the INR in the medium term will move in line with most of the emerging market currencies. The bigger call is that where do we expect the US dollar to be? US is, as an economy, is very strongly positioned. It's in the pole position right now in terms of driving global growth in the next few years. So that implies the outlook for dollar is quite positive. In case of India, it is also in a pole position to drive growth higher. However, if the export-linked growth does not kickstart in case of India in the coming few quarters, as we saw in the 2003 to 7 cycle, then of course the INR structurally will not move higher. It will be moving lower. And if we do see export-led growth kicking in because of the PLI scheme and some of the government initiatives, then of course we see a brighter future for the INR. So the jury in terms of medium term is still out because we need to wait and see how things will play out. But in the near term, I think the outlook is very clear. It is looking like a depreciating bias in the near term, perhaps a little bit of appreciation in H2. On balance, we will perhaps be closer to the 74 rupee mark than anything else.
Right. And very lastly, Samir, all this while you were talking about the growth that would come in from rural India.
Right.
Now, what's happened is with regards to COVID, it's started to go to tier 2, tier 3 cities. In fact, there are villages which are getting infected as well. Do you think that's something which could take us show us a reverse turn on that? Because urban is already getting infected.
Right.
You have the pandemic which has started to move to smaller cities, probably tier 2, tier 3 as well. How is that probably going to impact growth?
So the way to look at the rural side is perhaps that in urban India, particularly bigger cities, the the extent to which you can do social distancing is pretty much impossible because of the lack of space, because of the overall urban infrastructure that we have in this country. It's very, very difficult to practice social distancing in urban areas in the country. And of course, if you have COVID appropriate behavior, that slows it down. But we've seen in the last couple of weeks and months that we've lacked that. In case of rural India, that shouldn't be a challenge, simply because of the availability of space and uh, you know the execution of probably social distancing that can be done in smaller towns and rural areas because of availability of space. So from that context, I think it's easier to slow down the virus there than it is to in urban areas, and that is what we have seen. That as we were talking initially, that people have been bringing it with the kids or family members bring it home, but social distancing is not possible, so everybody gets infected, and then those people again go and meet other people, and that's how the transmission is happening. But that you can slow down in rural areas much more effectively. So my sense is that I would not be that worried about rural areas as you would be in urban areas. The data flow still shows that it's mostly an urban-led issue. It's not a very rural-led issue. Where be it Africa, the countries which are more rural in nature, which are present in Africa, for instance, it's not much of an issue. Though Brazil is an exception, I think the entire country is ravaged with COVID. So it depends on when you can restrict the infection. But my sense is that still rural India will not be that badly impacted.
Right. All right, Samir. Thank you so much for these candid views that you've given us. Always a pleasure to speak to you. I hope you enjoyed the conversation as well. Speak to you soon again and stay safe.
Thank you. All the best. Thank you.